Welcome back. We're going to dig into one of my favorite sections of business law, tax law. We'll touch on tax law basics. Tax is used by the government for both revenue raising and policy development. They can use tax credits to get you to do something. They can tax something heavily, which is called a sin tax, to get you to stop doing something. So taxes aren't just for raising money. It also is used to change behaviors. And in business, we see this routinely with tax credits or tax incentives to build things or put businesses in certain locations. We're not going to dig into those in any level of detail in this course. However, be aware that there may be opportunity zones or other local, state, or federal tax incentives for you to locate your business in a certain area, to hire certain people or categories of people, or to do business with certain types of businesses based upon tax policy. As a business owner or as a manager, you are subject, and your business is subject to state, local, as well as federal taxes. You're going to have to analyze where you have tax nexus. And tax nexus is the area in which you're doing business and you are required to file taxes. Tax nexus is driven by how much business activity you have, whether you have any employees in that area, whether you have any leased property or owned property in that area, and what type of business, not just how much, but what type of business you're conducting in that area. You will be surprised on how many locations you may have tax nexus in, particularly if your business is an internet-based or e-commerce type business where you're touching a lot of localities. One of the keys to working your way through tax successfully is to keep good records. Federal law requires that you keep all business records for 3 years to support any filings that you make with respect to your federal taxes. State law generally mirrors the federal law, but you're going to want to know your local jurisdiction. You need to keep prior year returns without the supporting documentation indefinitely. And this is useful not only for tax in the event that you're actually audited, but it's also useful in the event that you have to claim on your insurance policy, business continuity, or lost profits to be able to show and demonstrate what your profitability was. It's also going to be useful during a due diligence process to be able to show the expenses incurred by your business. So you want to keep prior returns, but without all the supporting documentation indefinitely. Make sure from a tax law perspective that you keep your personal transactions and your business transactions separate. Account for them separately. They're treated separately for tax purposes, and so the more you commingle those two, the more confusing it is for the service in the event that you are audited, or for your accountant when they're preparing your returns to get it right. And if in doubt, the service will find against you and have you pay more tax. The other thing you're going to want to keep long-term records for is permanent records of depreciable assets and how you came up with their basis. Sometimes you have exchanges or trade-ins that go back years and years and years, and coming up with an accurate basis and being able to prove that in the event of an audit, or to hand off to your accountant, or at the time at which the business is sold and you have to recognize a gain or loss, is going to be critically important. So keep really good records. It's going to make your tax life much easier. The tax type that you file will follow the entity type which you created. Just walking through these, we touched on them a little bit in the entity section, but a sole proprietorship is going to file a Schedule C with your 1040 and a Schedule SE, self-employment, with your 1040. Schedule C is your business income or loss, and Schedule SE is your self-employment tax, Social Security and Medicare. Partnership and limited partnerships will file a 1065 on behalf of the partnership, which is a partnership return. Each of the partners will receive a K1, a Schedule K1, which will go through to their 1040 and is their share of profits, distributions, or profit and loss associated with the partnership. And you'll also likely have to file a Schedule SE for the Social Security and Medicare tax associated with the self-employment income coming off the partnership. An S corporation will file a Form 1120S and you'll receive a K1 like you do with a partnership. It's a pass-through entity, what's called a pass-through entity, which means the business income, instead of the business paying it itself, will pass it through to the owners or to the partners. And so that pass-through notice is called a Schedule K1, and that goes on your 1040. There's no Schedule SE required in a S corporation because you are also going to receive a W-2 for your wages that are paid by the S corporation to you for your salaries and bonuses. The C corporation will file a Form 1120, so not an 1120S, but an 1120. It pays the taxes on its own. It has its own tax schedule, and it will pay the taxes directly to the federal government. And if you are getting paid from the C corporation, you're going to receive either a W-2 for your wages or a 1099 div for any dividends. So you'll receive a 1099 for your dividends, and you'll receive a W-2 for your wages. For an LLC, it depends. As we talked about, LLCs are extremely flexible entities, and they could be taxed as a partnership, as a corporation, as an S corporation, or as a disregarded entity if you are the only owner of the LLC, and it'll be a Schedule C. So the LLC is taxed as either a partnership, a sole proprietorship, an S corporation, or a C corporation. Those four methods are the only four methods that businesses are generally going to be taxed as. And again, when you are setting up your business, the tax considerations for setting up your business may be the most important considerations early in the business life, and you're going to want to work with your tax advisor, your accountant, CPA, whomever, to make sure you get that right, and that may then drive what the entity is that you choose to do business with. The professional entity, so PC, PLLC, PLLP, LP, those professional entities which cover the licensed professions, the professional designation is ignored for federal tax, and it's either taxed as sole proprietorship, partnership, S corporation, or C corporation. And limited partnerships are taxed as partnerships. There's a few tax issues to remember. If the entity files a return, so for partnerships and corporations, S or C corporations, an employee identification number is required, and if you're going to hire employees, even if you are a sole proprietorship, an EIN is required. In general, an EIN is free to get, easy to get, and you probably are going to want it anyway. It also helps with your banking relationships. So an EIN is ultimately required if the entity files a return or hires any employees. If you're making money, you may need to pay estimated taxes quarterly on behalf of the business if it's a corporation, or on your own behalf if it's a pass-through entity, or you'll end up paying penalties. There's safe harbor provisions which identify how much you need to pay as a minimum in order not to pay penalties, and that's beyond the scope of this course. But if you're in a situation where you have a business and you're making money, and it's more money than you're making as part of your W-2 wages, or you're not being paid W-2 wages, you're going to need to pay estimated taxes quarterly, or you'll end up having to pay penalties for not remitting money fast enough to the IRS. If you have employees require that you withhold Social Security tax and federal tax, as well as applicable state and local taxes from their paycheck. They also require that there's employer-side taxes be paid. So that could be state unemployment tax, federal unemployment tax, any other state taxes that might be assessed, local taxes that might be assessed to the employer, as well as the federal side employer portion of FICA, so the Federal Insurance Contributions Act, which is Social Security and Medicare. You're also going to have to provide year-end reporting. So W-2s, if you have contractors, you're going to have to file 1099s. So I've always strongly recommended that if you're going to have employees, hire yourself a competent payroll service. That might be one that works with your accounting program. That might be one that you work with separately, but a competent payroll service will more than pay for itself if you have employees just in the risk associated with noncompliance. Another tax issue to remember is a business versus a hobby. If you're not trying to make a profit, and if you don't make a profit in at least 3 of the last 5 years or so, the IRS may view what you're doing as a hobby as opposed to a business. So you might be trying to raise horses, but you also have another job. The IRS will look at the totality of what you do, how often you do it, how much money you've invested in it, whether you're trying to raise other money to grow the business, how many customers you have. And if they deem it to be a hobby, as a side hustle hobby, as opposed to a real business, and you're showing losses, they may disallow the losses. And you'll only be able to take them later if you start making money. So be very careful. If you're going to have a business, you should have a business plan. You should be working it in a regular way. You should have outside clients. You should be doing everything that you would expect a business to do. Otherwise, the IRS may say you don't have a business, you have a hobby. Hobby losses are disallowed. And if you've got family members and they're on the payroll, they actually need to do something. So family members must perform legitimate work if on the payroll. Otherwise, the IRS may look at that as a way that you're trying to push some of the profits of the business into a lower tax bracket by paying your children or somebody else in the family as opposed to paying it at your marginal tax rate. So if you have a family member in a business, make sure they're actually performing legitimate work, pay them above board so that you can take the deduction, and everybody will be much happier. This is just a touch on tax issues. We're going to dive into it a little bit deeper in the next couple lectures.